sustain growth?
Affin Bank has always prepared itself for the worst. So current situation is no different. We are all ready for it because Affin Bank builds its assets on the basis of fundamentals. And the fundamental means that it is prepared to actually take the difficult time, be able to handle our business during difficult time. Actually, I think for difficult time, we probably, in terms of performance, I think we'll probably do better than the industry.
When you mention we are always prepared for the worst, what kind of scenario do you have in mind?
We are prepared we prepare ourselves via the business we do, that is the loan books. The loan books, we only take, we understand our customers very well, and we know our customers' business. And in this case, we will say this, we have a policy to face the situation. Our approach to handling the situation with our customer is this. We want our customers to stay in business. So these customers that face slowness, they will face a slowness in the economy, right? But that has been factored. So in this case, if they face slowness, if our business are affected by global economy, right? The customers still use our facility. They probably ask that the terms will now be stretched. Yes, we will do it. Default, they don't. So in that case, I think we have a very robust portfolio. Basically, it boils down to what? We understand our customer better. I say this again. We want our customer to stay in business. We are very engaging. And then, why is that important? Because we don't want any of our customers to think that difficult times we are running away. We are staying with them. We are riding it with them. Consequences will be bad, you see. If, for example, if the customer see that we're not supporting, they just close the business. You know what's affected? Not only their business, you find that their employees are affected. Their employees have car loans, housing loans, have Visa cards, or have credit cards to pay. So, in that sense, we believe that our customers will stay in business. And we learned this from the 1998. Part of 1998 problem was the bank.
Yes.
Because the bank get into panic mode and solving their own problem by actually pulling lines from the business side. So the problems of the banks at that time were passed on to the business, and we pull lines from the business collapsed. That create a domino effect. Technically create problem for the banks. Viable business can be guaranteed that will support them all the way to ride these tough times. In 1998, they couldn't differentiate between viable and non-viable business. Banks just trying to solve their problem by actually saying that cut the lines, pull back. So viable business also go out of business. And I've seen this before. So this time, we have learned from it. No, it's not going to happen in Affin.
What is the outlook for loans and deposit growth for your bank?
Loans, we look at it, these present circumstances, we see loan will continue to grow because the need for cash flow support will be greater now. Therefore, the need for loans will be there. Deposits, will also grow because somehow or other there's a migration to cash. Migration to cash. And given that the banks, not only Affin, I think the banks in Malaysia are very strong, capital-wise and financial structures-wise, their money is safe. So the next best place with return, other than your home, If you think your home is, but the banks, there's no safer place than the banks to keep your cash. If you think your home, where's the safest place? My view is the safest place is with the banks. Nowhere else to save. Today, you're guaranteed by PIDM, you're safe, and you're guaranteed by Bank Negara Malaysia. Anywhere else you keep, right? You're not guaranteed by anyone. So, yes, I think we are flush with liquidity. Is there a credit crunch? There's none. Is the bank cautious about lending? The bank has always been cautious. After 98, we've always been cautious about lending. So viable business has no problem in having access to credit. So I used to say this, and I keep on saying, it's business as usual. We are not in the US, you know. And then we still have very high level of confidence in lending interbank, not in US. They have problem with that. So if you look at it, 98 has helped us a lot. 98 has actually built strength to face 2008. So if you look at it, the difference between some of the other global banks outside Malaysia entering the crisis, the Malaysian banks entering the crisis with strength, and you don't find any excesses or abuses that can actually put them in a difficult position. You can't find that, you know. So, and this also you'll see because of supervision. There's a close supervision by the central bank. I keep on saying also this, we are stress tested continuously. So they would have detected any banks that if they are having problems, number one. And I think if any banks have having to face the situations, the central bank will have difficulty in answering.
Do you find this situation unique to Malaysian banks, or you can find a similar level of confidence and strength in other banks in the region?
I can't say for sure because I'm not familiar with the other banks in the region. But looking at how some banks in the region are also facing, you know, problems, we probably a bit different. In the sense that, keep on saying about these, what do you call? We've learned our 1998. 1998 is tremendous learning for the banks, shareholders of the banks, and for the central banks, and for the government. We all learn from it. That's why you see Malaysian banks, there's no cry for help. There is no issues about liquidity. There's no run. There's no panic. You know, as it is now, any businesses that come and say they cannot borrow money, something's wrong with them. Good business are always welcomed by the banks. So we're not facing the similar situation in the US. But at the same time, we acknowledge that the global economy has an impact on our customers. There'll be a slowdown. Customers will face less in terms of revenue. They would probably slow down in the way they repay. But we're willing to ride it through. The bank is a partner. The bank today are willing to ride it through with the clients. All they need to do is come and talk to us. We are in it together. No panic.
How do you see the growth for consumer banking and corporate banking in Affin?
In Affin, very balanced. We've defined the risk we want to take, whether consumer or corporate. In consumer, we go on the basis of ability to repay. We just don't build asset. The most important part is ability to repay. Whereas in the US situation, you find it's asset building, right? Ability to repay is secondary. Whereas in Affin, ability to repay is primary. In other words, we are very much cash flow driven. Whether individual or corporate, it's very much cash flow driven. So we ourselves do not help to create an asset bubble.
With the lackluster bond market, how are corporates raising funds? Do you see a danger in the resurgence of corporate loans?
They have already moved towards bilateral borrowing now. They have also found the difficulty, the problems of issuing bonds and all that. So now, in terms of borrowing, I think we are seeing corporates now tend to go into bilateral borrowing, directly, like you say, corporate loans. This already a move. Bond is now less in demand. Basically, because they found that for borrowing via bonds, they have to deal with so many bondholders, and the bondholders keep on changing all the time, and there's no relationship, not built, So when it comes to situation like this, it's very difficult to gather everyone and get everyone to agree with what you want to do. Whereas if you are on a corporate loans, bilateral type of relationship, you can speak to your lender, your banker, and they probably understand, and you would probably get to restructure or support from them. Bonds, really, you do not know who's they keep on trading on the bonds. You won't know who's the ultimate holder of your bonds. It is changing. The market is slowly changing, but it's no different now, because now the corporate loans have caught up in structure, almost like bonds. So you tend to get longer term loans now. And then in terms of there are a lot of pricing flexibility. Then it provides very responsive to situation. Corporate loan is more responsive to situation, whereas bonds are more fixed. So I think over time, it's caught up. But I agree with you that if at any one time, if you have substantial exposure to any one group or name, yes, you take a risk. But that is the same with bonds too, right? If you hold a big chunk of the bond papers of one issue, you still have the same risk. So you don't. So it's very important is the bank's risk management itself, how they actually define their risk parameters, whether it's corporate loans or bond. It's no different.
What are the factors affecting the bank's profitability? Do you see margins becoming even more squeezed in the current interest rate scenario?
Margins has always been squeezed, whether current scenario or because borrowers who actually in better position, they not easy. We can't get good margins. Even today now, you find narrowing of between deposits and lending rate. We have to pay more for deposits now, right? And lending rates now are being pressured down, because borrowers keep on. You look at the mortgage market, very intense. You look at the HP market, higher purchase, very intense. Corporate side, no different. So it's as society gets more educated, more aware, right? And then as a company do better, they expect better rates. Just like bonds, they get better ratings. So companies also know that they get better rates. So it's always the risk profile of company has improved, therefore they get better rates. That put a squeeze on our margin. It's always a challenge to maintain our margin.
More so in the current interest rate scenario?
More so, yes. Current scenario is even tougher, because you cannot burden the borrowers with higher interest rate. You cannot get higher margin because of the current environment tells you that if ever they need to actually be able to afford it. Putting on that will put on a high cash flow pressure on them. Again,
so how are banks able to juggle, all these margins?
if you look at, if you say just now, do you think it doesn't make sense sometimes? If you say deposits at 4.8, if your BLR is 6.8, right? 6.8 minus 2.5 is 4.3. How do you get a deposit of 4.8 to finance a mortgage loans of 4.3?
But these are by separate banks.
I know, but we are banks, what you call in a market where the differential cannot be that large. So there must be some, other requirements. If you say how can the bank, it depends on the bank's portfolio, how they want to actually shift their portfolio, how they actually factor their cost model. So for those who do 2.5 below base, fine, they probably have their own model. But you find that the other banks that don't give also have a lot of loans that they lend to the mortgage market. So it depends. It appeals to a different set of customers, number one. It also depends on the bank itself. What are their balance sheet adjustments they want to do? But 4.3 is good rate. 2.5.
Good rates, huh? What could be the other factors that affect banks' profitability in current times?
I'm a strong advocate. The one that always kills the bank, you will find the middle weapon is bad loans.
Sorry?
Bad loans.
Bad loans.
Bad loans. Bad loans. So banks, that affects profitability, number one. Number two, the bank must also avoid the frauds. If you look at it, the check, you'll find that checks, we have solved substantially on the credit card by going with cheap base, right? But then another factor will affect the banks is when they take big bets on certain transactions. Example, if they go treasury, right? If they take big bets on papers and all that will affect their profit. When the market take a turn, interest rate take a turn, will affect them. But most banks are affected. If you see bottom line profit, is always provisioning for bad loans, for mark-to-market losses. That will be the biggest.